As the U.S. markets are currently closed, Opendoor Technologies Inc., trading under the ticker OPEN, finished Friday's session on September 5, 2025, at a price of 6.65. This represented a significant intraday surge of 11.58%, a powerful move that has many investors buzzing with renewed optimism. But behind this single day of impressive gains lies a much more complex and turbulent reality, one that is far from the straightforward growth narrative that such a price jump might suggest. The expectation is that Opendoor, a pioneer in the iBuying space, is finally turning a corner, capitalizing on a shifting real estate market and leaving its past struggles behind. The reality, however, is a company navigating a treacherous landscape of macroeconomic pressures, intense competition, and a business model that is still proving its long-term viability. This isn't just a story of a stock's daily performance. It's a deep dive into the very foundation of a company attempting to revolutionize one of the world's oldest and most entrenched industries. The immediate catalyst for this recent surge appears to be a confluence of factors, including a broader market rally and a renewed interest from retail investors, fueled by social media chatter and a desire to find the next big disruptive technology stock. This retail-driven enthusiasm has created a powerful tailwind for Opendoor, pushing its stock to levels not seen in some time. The expectation here is that this momentum is sustainable, that the smart money of institutional investors will soon follow the lead of the retail crowd, and that this is the beginning of a sustained upward trend. However, a closer look at the institutional ownership data reveals a more nuanced picture. While there has been some increased buying from certain funds, there has also been significant selling pressure from other large institutions. This divergence of opinion among the so-called smart money is a critical piece of the puzzle that many retail investors may be overlooking. It suggests a deep-seated uncertainty about Opendoor's future, a reality that stands in stark contrast to the unbridled optimism currently driving the stock's price. To truly understand the forces at play, we must delve into Opendoor's recent performance and the broader economic environment in which it operates. The company's latest earnings report, while showing some positive signs, also contains some red flags. The expectation was for a significant improvement in profitability, a clear indication that the company's cost-cutting measures and strategic pivots were bearing fruit. The reality was a mixed bag. While revenue did see a modest increase, the company continued to post a net loss. This is the central tension in the Opendoor story, the promise of future profitability versus the current reality of burning through cash. The company's management has been keen to highlight their progress in reducing losses and improving unit economics, but the fact remains that they are still not a profitable enterprise. This is a critical point that cannot be overstated, especially in a market that is increasingly focused on fundamentals and less tolerant of speculative growth stories. The macroeconomic backdrop further complicates the picture. The real estate market, which is the lifeblood of Opendoor's business, is in a state of flux. The expectation is that with the Federal Reserve signaling a potential pause in interest rate hikes and even the possibility of rate cuts in the coming year, the housing market will see a resurgence of activity. This would, in theory, be a major boon for Opendoor, as it would lead to increased transaction volumes and a more favorable environment for their iBuying model. However, the reality is that the housing market is still grappling with affordability issues, and even with a slight dip in mortgage rates, many potential buyers are still priced out of the market. Furthermore, the iBuying model itself is inherently sensitive to fluctuations in home prices. A sudden downturn in the housing market could leave Opendoor holding a large inventory of homes that are worth less than what they paid for them, a scenario that could have devastating consequences for their bottom line. So, what exactly does Opendoor do, and how does its business model work? At its core, Opendoor is a technology-powered real estate company that aims to simplify the process of buying and selling a home. The expectation is that their platform provides a seamless, hassle-free experience for consumers, allowing them to sell their homes quickly and with certainty, and to buy a new home with ease. They do this through their iBuying service, where they make a direct cash offer on a seller's home, and then, after purchasing the home, they make any necessary repairs and list it for sale on the open market. The reality is that while this model does offer a level of convenience that is attractive to some consumers, it also comes with its own set of challenges. The company's ability to accurately price homes is paramount, and any miscalculation can have a significant impact on their profitability. Furthermore, they are competing not only with other iBuyers, but also with the traditional real estate industry. which is a massive and deeply entrenched ecosystem of real estate agents, brokers, and other service providers. Looking at Opendoor's past performance, we see a company that has experienced both incredible highs and crushing lows. The stock's initial public offering was met with a great deal of excitement, and the share price soared in the early days of trading. The expectation was that this was a company that was poised to disrupt the real estate industry in the same way that Amazon disrupted retail and Netflix disrupted entertainment. However, the reality has been far more challenging. The company has faced a series of headwinds, including a difficult housing market, intense competition, and questions about the sustainability of its business model. The stock price has been on a roller coaster ride, and many of the early investors who bought in at the peak are now sitting on significant losses. This history of volatility is an important reminder that this is not a stock for the faint of heart. Now, let's turn our attention to the future outlook for Opendoor. What are the potential catalysts that could drive the stock higher, and what are the risks that could send it tumbling? On the optimistic side, there are several potential tailwinds that could work in Opendoor's favor. If the housing market does indeed stabilize and begin to recover, this would be a major positive for the company. A more active housing market would lead to increased transaction volumes, which would be a direct benefit to Opendoor's top line. Furthermore, if the company can continue to improve its unit economics and demonstrate a clear path to profitability, this would go a long way in assuaging the concerns of investors. The company is also expanding into new markets and launching new products and services, which could provide additional avenues for growth. Comment below with your thoughts on whether the government will pass any new legislation in the coming year that could impact the housing market and how that might affect a company like Opendoor. However, there are also significant risks to consider. The housing market is notoriously cyclical, and a downturn could have a severe impact on Opendoor's business. The company is also facing increasing competition from other iBuyers, as well as from traditional real estate companies that are adapting to the changing landscape. And then there is the ever-present question of profitability. Can Opendoor ever achieve a level of profitability that will justify its current valuation? This is the million-dollar question, and the answer will likely determine the long-term fate of the stock. The reality is that investing in Opendoor is a bet on the future of the real estate industry and on the company's ability to execute on its ambitious vision. It is a high-risk, high-reward proposition, and investors should be prepared for a volatile ride. In conclusion, the recent surge in Opendoor's stock price is a reflection of a renewed sense of optimism among some investors. The expectation is that the company is finally on the right track and that this is the beginning of a sustained upward trend. However, a deeper analysis reveals a much more complex reality. The company is still facing a number of significant challenges, and the path to long-term success is far from certain. The tension between the expectation of a seamless, profitable future and the reality of a challenging, competitive present is what makes Opendoor such a fascinating and compelling story. For investors, the key will be to look beyond the short-term noise and to focus on the long-term fundamentals. This is not a stock for those who are looking for a quick and easy profit. It is a stock for those who are willing to do their homework, to understand the risks, and to make a calculated bet on the future of real estate. The reality is that the journey for Opendoor will likely be a long and winding one, with plenty of twists and turns along the way. But for those who are willing to ride out the volatility, the potential rewards could be substantial.